current real estate market. The real estate market works according to the law of demand and supply. When supply is greater compared to demand, the price falls, and when the demand exceeds supply, the price increases. The real estate market crash has affected a lot of people in different ways. For some, it has meant the loss of their home or investment property. For others, it's meant the inability to sell their home or refinance their mortgage. And for still others, it's meant the postponement of their retirement plans. But regardless of how the crash has affected individual people, there is no question that it has had a profound impact on the economy as a whole. The housing market is one of the cornerstones of the economy, and when it collapsed, so did many other sectors. Construction came to a standstill, banks tightened their lending standards, and consumer confidence took a nosedive. As a result, the real estate market crash has been felt by everyone in one way or another, and although the economy has begun to recover in recent years, it will take many more years before the housing market returns to its pre-crash levels. This video will be about the current real estate market crash, so let's start. What's happening in this year's housing crash? In 2022, the housing crash has already started and it has caused a 20% drop in home prices in some neighborhoods. The prices on Zillow have decreased drastically, and the current situation of the US housing market bubble is changing. The US housing market bubble is rapidly turning into a crash. The prices listed on Zillow in markets like Los Angeles, Seattle, Denver, and San Francisco are crumbling. Moreover, the home buyers' demand has collapsed as well. The sellers are getting desperate, but there's nothing they can do about the prices of their houses. But what's causing the market to shift this fast? Well, basically the rising interest rates, inflation, and looming recession are the leading causes behind that fast shift in the housing market. Given how low mortgage purchase applications are to go along with the declining home buyer traffic, the 2022 housing crash might just be getting started. The expensive, tech-driven real estate markets are facing issues due to not having enough money or else paying a higher cost. Is it worse than the 2008 market crash? It's been over a decade since the 2008 housing crash, and many people are still feeling the effects. Given the current state of the economy, there's a growing concern that we may be heading into another recession. If this happens, home prices could fall by 20% or more. For many people, their home is their biggest asset, and a decrease in value could have devastating financial repercussions. Some experts are advising people to sell now before prices drop any further. Others are taking a wait-and-see approach, hoping that the market will rebound before they have to sell. Regardless of what people decide to do, the looming possibility of another recession is causing anxiety for homeowners across the country. Now the real question is the current real estate market crash worse than the 2008 crash? Let's find out. The United States housing bubble was a real estate bubble affecting more than half of the US. The housing prices hiked in early 2006, and then they started to decline in 2006 into 2007. By 2012, the prices reached new lows. In contrast to the 2008 crash, the 2022 market crash is different. It's expected to be far worse than the 2008 crash. The fear in the market seems to be rising, and with that fear comes panic selling. Most of the growth stocks are now down 80% from their market value. Why is the current economic recession different than the 2008 housing crash? There are a lot of reasons why the current economic recession is different compared to the 2008 housing crash. Let's take a look. Mortgages have been much more difficult to get now versus then. The Mortgage Credit Availability Index, or MCAI, is a barometer on the availability of mortgage credit using guidelines from institutional investors who purchase loans through the broker and/or correspondent channels. The higher the index, the easier it is for borrowers to get loans. The lower the index, the more difficult it is for borrowers to obtain a loan. Real estate is priced closer to true market value. The month supply of inventory needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued appreciation. Houses are more affordable today versus then. The affordability formula has 3 components: the price of the home, the wages earned by the purchaser, and the mortgage rate available at that time. 14 years ago, the prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high. Wages, however, have increased and the mortgage rate is about 3.5%. That means the average family pays less of their monthly income towards their mortgage payment than they did back then. We have a shortage of homes for sale today. The month's supply of inventory needed to sustain a normal real estate market is approximately 6 months. Anything more than that's an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued appreciation. Today, there's a shortage of inventory, which is causing an acceleration in home values. Home equity is much higher now. In the run-up to the housing bubble, homeowners were using their homes as personal ATM machines. Many immediately withdrew their equity once it built up, and they learnt their lesson in the process. Prices have risen nicely over the last few years, leading to over 50% of the homes in the country having greater than 50% equity. But owners have not been tapping into it like last time. During the crash, home values began to fall and sellers found themselves in a negative equity situation, where the amount of mortgage they owned was greater than the value of their home. Some decided to walk away from their homes, and that led to a rash of distressed property listings, foreclosures and short sales, which sold at huge discounts, thus lowering the value of other homes in the area. That can't happen today. Is there anything good about the market crash? While a stock market crash can be a scary prospect, it's important to remember that the market has always recovered from past crashes. In fact, depending on your investment strategy, a market downturn can actually present some more buying opportunities. For example, if you're a long-term investor, you may be able to buy stocks at a discount during a market crash. Or if you're a short-term trader, you may be able to take advantage of the volatility to make some quick profits. Of course, it's important to do your research and understand the risks before taking any action, but depending on your goals, a stock market crash may not be something to fear. Here are a few benefits of the market crash. A market downturn is an opportunity to get the same stocks at a cheaper price. You can accelerate the growth of your 401k. Contribution to the same amount monthly can help you pick up more shares on sales. You can reinvest some of your previous gains. What are the drawbacks of the real estate market crash? Crashes can lead to a bear market. That's when the market falls 10% beyond a correlation for a total decline of 20% or more. A stock market crash can also cause a recession. Stocks are an important source of capital that corporations use to manage and grow their businesses. If stock prices fall substantially, corporations have less ability to grow. Firms that don't produce will ultimately lay off workers in order to stay solvent. As workers are laid off, they spend less. A drop in demand means less revenue, which means more layoffs. As the decline continues, the economy shrinks, creating a recession. In the past, stock market crashes preceded the Great Depression, the 2001 recession, and the Great Recession of 2008. That's all there is for today. Thank you for taking the time to watch this video. Please leave us with your valuable feedback if you found this video interesting. Stay tuned until the next one. See you soon.